Well, there's been a lot of talk lately about silver being either the smartest move you can make in 2026 or the easiest way to get yourself trapped in a hype cycle. And in this video, we're going to separate the signal from the noise so you walk away calmer, clearer, and a whole lot more confident about what you're actually doing with your money. Because if you've been online at all, you've probably seen some version of this floating around. A clip, a post, a rant, whatever. It goes something like, new central bank boss, rate cuts coming, election year games, government stockpiles, China clamps down, industry demand explodes, supply can't keep up, gold already broke out, the ratio says silver's next, and price targets are basically inevitable. And on the surface, it sounds airtight. But when you slow it down piece by piece, you realize some of it is solid, some of it is stretched, and some of it is just people taking a handful of true facts and turning it into a guaranteed outcome. That's where investors get hurt. Now, before we get into it, today is Sunday, February 15th in New York. Comment what day and date you're watching from because I always love seeing how far these videos travel. And real quick, if you get value from this kind of breakdown, hit subscribe and drop our John AG in the comments. It helps a lot more than you think. Okay, let's build this the right way. There's a competitor script making the case that silver is a great buy in 2026, and they anchor it on a few big pillars. Silver has no counterparty risk. Policy is going to get easier. Politics will push it. Government might start hoarding. Industry demand is booming. Supply is tight. China is restricting. Gold is leading. And the gold-silver ratio sets up a catch-up move. That's the ingredient list. But what matters is how those ingredients actually behave when you put them in the oven. So first, let me address the part that's emotionally true, even if people say it in a way that's too absolute. The no counterparty risk idea. If you hold physical metal in your own possession, you're not relying on an app. You're not relying on a password. You're not relying on a brokerage staying open during a panic. You just have it. That's real. But here's what people quietly skip. Having no counterparty risk does not automatically mean good investment. It means different kind of risk because the moment you go physical, you pick up other risks. Storage, liquidity, spreads, theft, the reality that you might need to sell on a day where buyers are picky and premiums collapse. None of that is fatal, it's just not free. And there's a second layer that almost nobody talks about in these hype clips. The friction, the taxes, depending on where you live, the shipping, the bid-ask spread that only becomes visible when you try to get out. The time it takes to actually convert metal back into money when you need money fast. So when someone says it's perfect because you don't need anything, what they really mean is you don't need a counterparty to exist. You still need a plan. So I like the framing of metals as financial insurance. I don't like the framing of metals as a magic ticket. Insurance is boring on purpose. You buy it hoping you never need it. Investments are different. Investments need a thesis and a plan. Now, in this same competitor script, they also mentioned they've been stacking since early 2018, and they show older purchases to prove they've been consistent. I'm in that camp too. I've been buying for years. I've seen silver as dead phases. I've seen silver to the moon phases, and I've seen plenty of people who get wiped out, not because the metal betrayed them, but because their expectations were built on a fantasy timeline. So let's talk about 2026 specifically, and I want to start with something that sounds like a boring detail, but it's actually the pivot point for a lot of these arguments. Leadership. A lot of people are saying there's going to be a new chair. And that automatically means easier policy. Here's what we actually know. The current chair's term as chair ends in mid-May of 2026. So yes, there's a real deadline on the calendar, and yes, there has been real reporting about the possibility of a new nominee being pushed forward. But the leap people make is new person equals instant rate cuts, instant market party, instant metals boom. And that leap is where you can lose money because a new chair can be dovish or hawkish. They can cut rates and still tighten financial conditions in other ways. They can talk soft and act tough. They can focus on the policy rate or they can focus on the balance sheet, which influences longer term rates and liquidity in a totally different way. So if your entire silver thesis starts with new chair equals easy money, you're building your house on one plank. Now, the first big claim is basically policy is going to turn friendlier. Rate cuts, softer stance, and that's bullish for metals. We don't have to guess what the policy stance is right now. Based on the most recent official policy update, the central bank has kept rates in the mid 3% range, and they keep repeating the same message. We're watching inflation in the economy, and we'll adjust when it makes sense. So yes, rate cuts are a possibility, but possible is not the same thing as inevitable. And even if rate cuts happen, the reason for them matters. If cuts happen because inflation is cooling and growth is stable, metals don't always rip higher. Sometimes risk assets do better. Sometimes real yields stay stubborn. Sometimes the currency doesn't collapse. Sometimes everybody already priced the cut in months ago. If cuts happen because something breaks, jobs roll over, credit cracks, recession shows up, metals can do well, but they can also get smacked in the first wave. Because in a true scramble, people sell what they can, not what they should. So the rate cut story is not a one-way lever. It's more like a steering wheel. It depends what road you're on. Now, the competitor script also leans on politics, midterm elections, incentives, optics. That's not crazy. Election years tend to make everyone more sensitive to economic pain, not just in Washington, but in boardrooms, in households, everywhere. The pressure to look stable increases. But here's the skeptical interpretation you have to keep on the table. The central bank doesn't get to wave a wand and make groceries cheaper. And if inflation is already sitting around the low twos year over year, the we're in runaway inflation narrative loses some force. So if someone is selling you silver on the idea that inflation is spiraling and policy will supercharge it, you should at least pause because the actual data recently published looks a lot more like sticky but not out of control than burning building. That doesn't kill the bullish case. It just changes the flavor. Okay, now let's move into the part that feels like a big deal, because it is. Silver being added to the US critical minerals list. That happened recently. Silver was included in the final list released in early November of last year. Now, what does that mean? This is where people get carried away. Being on the list doesn't automatically mean the government is about to back up trucks and buy half the market. It doesn't automatically mean a strategic reserve is guaranteed. It doesn't automatically mean immediate shortages. What it does mean is that policymakers are officially acknowledging that certain supply chains are vulnerable, and they're putting a spotlight on materials that matter for economic and security reasons. And silver absolutely matters for that because it shows up in electrical circuits, solar cells, and a bunch of modern hardware that you don't want disrupted. Now, the competitor script says since it's on the list, the US might stockpile silver in 2026. That's possible, but if you're investing real money, you can't treat might as will because stockpiles take budgets, politics, timing, and usually a reason that the public can rally behind. It's not just a shopping cart, it's a process. And there's another angle here that's easy to miss. Sometimes the critical label matters less because of stockpiles and more because of incentives. Federal support for domestic supply chains, faster permitting, more attention from policymakers, more conversations about tariffs and trade rules. Even if nothing dramatic happens immediately, the label can change how businesses and governments think about securing supply. And that can change behavior at the margins. Okay, now here's where the story gets interesting, and where the competitor script is actually pointing at something real, even if the details get fuzzy. Industrial demand. This is the part a lot of people underestimate because they still think of silver like it's only a coin or only a jewelry metal or only a poor man's gold. That's outdated. Silver is a working metal. It's used, it gets consumed, it gets dispersed, and as the world electrifies, that matters. You want a simple picture? Think of silver demand like sandpaper. It's not glamorous, but it gets used up in little bits across a million projects. Now take solar. From recent US energy forecasts, solar additions are expected to stay heavy with another big build-out in 2026. Think over 20 gigawatts of new utility scale capacity being added. Solar panels use silver. Manufacturers have been trying to thrift it down per panel, and they've had success, but the volume growth is relentless. Then look at the power side of the economy more broadly. The same energy outlook points out that electricity consumption is picking up again, and one of the drivers is data centers, along with new semiconductor and battery factories. Data centers don't literally burn silver, but they do pull on the same bottlenecks: wiring, connectors, power management, grid upgrades. All of that is metal intensive. And if you want a subtle but important detail, here it is. When a sector becomes a must, it doesn't just increase demand for the finished product, it increases demand for redundancy, backup systems, spare parts, overbuilding. That's how real-world engineering works. It's not optimized like a spreadsheet. So yes, the competitor scripts, instincts about AI and electrification pushing demand are not outlandish. The question is, how much, how fast, and how priced in, because markets are forward-looking. They don't wait for the ribbon cutting. Now let's talk supply, because this is where silver gets unique. The competitor script says, we've had multiple consecutive years where demand has run ahead of supply, and they point out that bringing on new mines is slow. Plus, much of silver production is a byproduct of other metals. That's broadly consistent with what the US mining data shows. Domestic silver comes from a small number of primary operations and a larger number of byproduct or co-product operations. In plain English, you can't just turn on silver supply like you're opening another checkout lane. If copper mines slow down, silver byproduct can slow down. If base metal projects get delayed, silver supply gets delayed. If grades fall, costs rise, and investment gets cautious, supply tightness can linger. So the supply side has inertia. It's like steering a cargo ship. You don't pivot on a dime. But this is also where I want to challenge one of the scarier implications people try to sneak in. You'll hear, we've had deficits for years, therefore the world is running out. That sentence is doing a lot of work because a deficit in the context of annual supply and demand is a flow problem, not necessarily an immediate stock problem. Here's the analogy. Imagine a busy restaurant. Every day, the kitchen uses more ingredients than it receives from the morning delivery. That's a daily deficit. Does the restaurant run out that day? Not if it has a pantry, not if it has a freezer, not if it can substitute, not if it can raise prices and slow demand. So when you hear deficit, your next question should be, okay, compared to what inventory and how elastic is demand at higher prices? That doesn't mean deficits don't matter. They do. Deficits force trade-offs over time. They pull down inventories. They raise sensitivity to shocks. But it's not the same thing as no metal exists. And that's why you can have a long, slow tightening cycle that supports a bullish thesis without needing to believe the apocalypse story. Now, the competitor script also throws around big price targets, and they talk about silver already trading at triple-digit levels and then going even higher. Here's my take. Price targets are the easiest thing in the world to say and the hardest thing in the world to live through. Because it's not just the destination that matters, it's the path. If silver ever does sprint upward, it usually does it with violent pullbacks, fake outs, and days where you feel like an idiot for owning it. That's part of the deal. That's why it can outperform in bursts. And we've already seen how quickly silver can move when conditions line up. In late last year, silver hit new highs on a mix of easing expectations and supply tightness. And the broader story being discussed was that tight supply and policy shifts can both matter at once. So I'm not going to sit here and promise you a specific number. I will say this, if you think in real terms, not just nominal terms, Metals can look a lot less crazy at higher prices than people assume. Inflation changes the ruler, but inflation adjusted can also be abused as a sales tool because you can pick your starting date, pick your measure, and make almost anything look cheap. So treat it as context, not a prophecy. Now, we should talk about the gold leads, silver follows idea. That's usually true in the sense that gold sets the macro tone first. It's the currency metal. It moves when confidence moves. Silver is half currency story, half manufacturing story. So sometimes silver lags because the manufacturing side is weak, and sometimes silver outruns gold because the manufacturing side is on fire and the market gets tight. That's why silver is weird. It can be a precious metal and an industrial metal in the same week. Now, the competitor script says central banks are buying gold heavily, and that gold leadership is a bullish omen. And on the central bank point, the publicly reported numbers for late last year show continued strong official buying. Here's the nuance, though. Central bank buying supports the idea that gold is being treated as a reserve asset again, and that tells you something about how governments view currency risk. But it doesn't give you a timetable for silver. It gives you a backdrop, and that backdrop can be supported for years. Okay? Now, we have to talk about the China angle because the competitor script claims China is restricting exports of silver and keeping more metal inside the country. Here's the honest version. There is real precedent for export controls and trade restrictions on industrial materials. In recent years, you've seen countries weaponize supply chains for strategic leverage. That's not a conspiracy, that's geopolitics. But I have not seen a clean, broad, universally verified rule that says silver is broadly restricted in the way people imply. So this is where I want you to be careful. Sometimes China is restricting becomes a placeholder phrase people use to make any bullish thesis feel urgent. The more useful way to think about it is this. The world relies on concentrated refining capacity and concentrated manufacturing capacity. If any major player tightens rules even a little, it can shift flows, raise premiums, and make local shortages feel worse. So, yes, the risk is real, but no, you shouldn't build your entire thesis on a headline you can't pin down. Now, let's talk about the gold-silver ratio, because this is the part that feels like a cheat code. The competitor script says something like, when the ratio is high, silver is cheap relative to gold. When it compresses, silver outperforms. That's a useful framework, but it's not a timing tool. It's a compass. And here's the trap. People treat the ratio like gravity, like it must revert on their schedule. It doesn't. The ratio can stay stretched for a long time. It can move for reasons that have nothing to do with silver being undervalued. Sometimes it's gold being bid as a crisis asset. Sometimes it's silver lagging because industry slows. So, yes, I like using the ratio to guide accumulation. If the ratio is elevated, it can make sense to tilt more silver, especially if you're younger and you can stomach volatility. But you still need rules because silver's volatility is not a personality trait. It's a cost. And this is where a lot of people get blindsided, especially if they've only ever watched charts. There's silver on a screen, and then there's silver in your hand. And they do not behave the same way in real life. When the screen price jumps, dealers often widen spreads. Sometimes premiums pop, sometimes premiums don't because inventory is fine and everyone is just repricing risk. Sometimes you'll see the opposite. The screen price falls, but physical stays stubborn because people refuse to sell. So if your plan is physical, you need to stop thinking like a day trader and start thinking like a shop owner. What is my buy price? Alan. What is my sell price? Alan. How quickly can I convert this if I need to? And here's the cliffhanger that most people miss. The best time to buy isn't always when you're most excited. The best time to buy is when you can still breathe. Because once silver starts moving fast, your brain changes. You start anchoring to round numbers. You start assuming every dip is the last dip. You start listening to whoever sounds most confident. That's when mistakes happen. So, whatever your silver thesis is for 2026, your real edge is not predicting the headline. Your edge is having a process that doesn't collapse the moment the price starts messing with your emotions. Okay, now let's circle back to something that was in the competitor script, but is actually a great retention hook when it's done honestly. They said they've got recent purchases coming in the mail, and they'll show them later. I do that too. And I'll tell you why it matters beyond just showing shiny stuff. When you're stacking, consistency matters more than drama. If you only buy when everyone is excited, you're usually late. If you only buy when everyone is bored, you're usually early. So, for me, it's not about predicting a single month. It's about building a position in a way that I can live with regardless of headlines. And this is where I'm going to drop a little practical strategy that you can steal. Whether you're pro-S or skeptical, decide your maximum allocation first, not your dream allocation, your maximum. Then decide how you will buy all at once or in pieces. For most people, pieces are better because it keeps you from making one emotional decision that you regret. Then decide what would make you add more. Maybe it's a pullback, maybe it's a ratio level, maybe it's a calendar schedule. Whatever it is, write it down and decide what would make you stop adding. Not sell everything, just stop adding. That alone can protect you from chasing. Now let me add a layer of fresh context that most silver hype videos skip. A lot of silver demand growth is tied to capital cycles. Solar build-outs can surge, then pause when financing tightens. EV adoption can accelerate, then slow if subsidies change or consumers pull back. Data centers can expand fast, then hit grid constraints. So demand is real, but it's not a straight line. And that's where the silver is always a good buy claim needs an asterisk. Silver is not a savings account. It's not a bond. It's not even gold. Silver can underperform for long stretches. It can do nothing while everything else is moving. And then when it finally moves, it can move so fast you feel like you can't catch your breath. So if you're going to own it, you need to decide what job it has. Is it insurance? Is it a volatility play? Is it a long-term store of value outside the system? Is it a trading vehicle? The wrong move is mixing all of those in your head at once and then panicking when the price action doesn't match your favorite story. Now, the competitor script frames 2026 like it's a special year with a new chair, possible cuts, elections, government interest, industrial demand, and supply tightness. Some of those are real, some are plausible, some are unknown. So here's a cleaner way to think about it. If rates drift lower and liquidity improves, metals tend to get more oxygen. If inflation stays sticky enough that people don't fully trust the back-to-normal story, metals stay relevant. If industrial build-outs keep accelerating, especially in power and manufacturing, silver demand has a sturdy floor. If supply remains slow to respond because so much production is tied to other mining decisions, tightness can linger. And if silver's critical designation changes policy incentives, even indirectly, it can add a new layer of demand and a new layer of narrative. That's the reasonable bullish case. One more thing, because this is where 2026 can surprise people. There are basically three broad paths the economy can take. One, a soft landing where growth slows but doesn't break, inflation cools gradually, and cuts come slowly. In that world, silver can grind higher, but it may not be cinematic. Two, a hard landing where something snaps and everyone rushes for cash first. Silver can dip with everything else and then recover hard once the dust settles. Three, a sticky inflation world where prices calm down but don't fully behave and policy is stuck in this awkward middle. That's where metals can stay in the conversation for a long time, even without fireworks. No path is guaranteed, so stay flexible. Now, here's the reasonable bearish case, and you need to hear it. If growth slows and industry pulls back, silver can get hit harder than gold because it's more tied to manufacturing. If inflation stays contained and real yields stay attractive, metals can go sideways. If the critical mineral story doesn't translate into real purchases or real policy changes, the excitement can fade. And if everyone is already positioned for the same bullish outcome, the market can punish that crowd, even if the long-term thesis is still alive. So, silver can be a good investment in 2026. It can also be a frustrating investment in 2026. The difference is not the metal, it's your expectations and your plan. Now, I want to give you a practical framework that mirrors the logic style of Script A without copying its facts. Instead of asking, will silver go up? Ask what would have to be true for my strategy to work. If your strategy is buy physical and hold, then your success metric isn't next month's price. It's your ability to consistently add, store safely, and not get shaken out. If your strategy is play a breakout, then you need risk controls, stops, position sizing, and the humility to admit you can be early and wrong. If your strategy is hedge currency risk, then you need to accept that hedges sometimes look dumb for a while. That's fine. That's what hedges do. And by the way, if you're successful, share your success story in the comments so others can stay motivated, because most people only comment when they're angry. Let's balance that out. Now, I also want to address the life stage point from the competitor script because it's one of the few pieces of personal finance advice that actually makes sense. Silver takes space. It's heavy, it's bulky, it's a pain to move compared to gold. As you get older, convenience matters. Volatility tolerance changes. Storage priorities change. So it's totally reasonable for someone to tilt more toward gold later and more towards silver earlier, as long as they understand why they're doing it. And if you're someone who measures wealth in ounces instead of dollars, I get it. That mindset can keep you from getting hypnotized by the screen, but you still have to live in a dollar world. Bills are in dollars, taxes are in dollars, emergencies are in dollars. So I like the think in ounces philosophy as a psychological tool. I don't like it when people use it to pretend liquidity doesn't matter. Everything we talked about today is for education and general information only. I'm not your financial advisor. I don't know your situation, and you should make your own decisions or talk to a qualified pro before you put real money on the